GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, good morning, Jim. Good to be with you.
It looks like the markets are rebounding from the panic that we saw right after the Brexit vote.
Oh, yeah, that was a terrific panic. You know, you had one of the big German banks dropping 20% in one day, and that stock had been remarkably weak for a good part of the year. So, yeah, it was a terrific shock. I think that obviously it was overdone and stabilized, and then I'm sure also that central bankers around the world were very ambitious in buying whatever they thought would help the markets. That would be corporate bonds in Europe with the European Central Bank. But, you know, there's something fascinating going on with that one, because beginning a little more than a year ago, when Draghi, the head of the ECB, was talking about coming in and buying the corporate bond market in Europe, it's a pretty thin market. I mean, bond markets are no longer as liquid as they used to be, and so there was some concerns that there wouldn't be enough bonds for him to buy, and then it was brought forward a week ago as a shortage of securities, looming a shortage of bonds, and that reminds me back when I was on the brokerage side of the business in 1967, 68, you had in Canada and the U.S., well, everywhere, most of the big financial institutions, including life companies and casualty companies, were heavily weighted in fixed income. And interest rates were very low, and then they started going up, which meant bond prices were going down, particularly during the late 50s, early 60s. And then came in the modern portfolio theory that big funds had to have equities. So this was the big deal. So the word was that bull market was peaking out in 68, I think it was there was going to be a shortage of equities. So therefore everybody had to buy equities. Now there was also an interesting facet with that. One was that with an unprecedented number of financial institutions coming into the equity markets would become much more rational and less volatile than ever, because you had these professional money managers coming into equities. Well, that did not turn out to be the case. That was associated with a very important high. If you take the S&P and divide it by the CPI, rate of inflation, it went into a bear market from that 68, I guess, right down to 1982, when then the world lost its interest in speculating in commodities and wages and stuff like that, and you had a terrific setback, and that then was the bottom of that bear market in real terms. And that was the beginning of our current new financial era, of which this isn't the first one, where the speculation shifts away from tangible assets and commodities into financial assets. And this is what the main game has been, as they call it, serial bubbles. And the errors done by the central bankers are truly magnificent, because they look at CPI inflation, which from time to time has been quite subdued, and they think because there's no CPI inflation, then we can stimulate the economy without getting inflation. So this is what they've been doing, but then you have another team of government people who put in all kinds of rules and regulations in the economy and in business and in private life that puts a heck of a lid on business activity. And so you're not going to get the economic expansion that you'd get with more of a freer economy. So you have constrained business and then constrained growth. And then you got the guys at the Federal Reserve, for example, or the Bank of Canada, take a look at it and say, oh, it's below its natural growth, we can stimulate. So certainly part of the quantitative easing programs were put in under the stimulus of a panic. But it's continued, and you see them going on that, well, the economy's the weakest expansion since the 1930s, and so then they throw more juice at it. And so you get then, what we've seen now is that the public ultimately decides which item will be speculated in, and it has been real estate, junk bonds until a year ago, stock market, still speculative. So this is then an absolutely weird world where one set of bureaucrats does one thing that constrains growth, and another set of bureaucrats look at it and say the growth isn't good enough, I'm going to juice it with some credit. And so here you are. In, let's call it a highly inflated world, inflated expectations out of the financial world. So you've got the central bankers buying the market. Quite likely they were buying everything. We know that central bankers have taken their own reserves, which in a more traditional time would have been holding gold as a reserve, and they then look and see no return from that. So when interest rates were higher, they then decided to hold, notes and bonds, mainly in the U.S., because it was a more liquid market. And then, of course, due to intense speculation in bonds, yields have gone down. So then that return is not seen as satisfactory. So central bankers have actually been putting stocks. They've taken up with the common share theory of investing and have started to put the bank reserves into stocks. So they've been buying a lot. So it's without precedent, and the resolution will probably be a severe contraction at some point.
Where are people supposed to go right now if you don't think the stock market is going to continue to rise?
Well, Jim, that's it. We should look and see the most popular positions are. By that I mean, say 6-10 months ago, most popular was real estate in financial capitals. Very popular was junk bonds, and very popular was the stock market. So you had important highs in these sectors last summer, and then you had a very dramatic change in the credit spreads to widening, and then that pushed off a number of problems. So You've seen, like Hong Kong, its residential real estate index peaked in August, and is down something about 12% on the latest posting. You've seen a real estate, one we saw with these trust fund, real estate trusts in England. I think an important big one, it had its net asset value at the highest right at the first of the year, and it's come down. You've seen a high-end real estate in Manhattan get into an oversupply and an underbid, and it's come down. The exceptions seem to be residential real estate in Vancouver and in Toronto. But elsewhere it's stalled out. And then I was talking to a friend of mine yesterday who is very high up in Ferrari circles, and the market for high-end, very expensive sports cars and collectors' cars has stalled out over the last year. So these asset prices are stalling out. And as they get weaker, there'll be a problem. But one of the key things is in England with last week there was one of these open-end funds stopped trading. They couldn't redeem. And the way that works is like on a stock mutual fund, you put your order in to have for redemption, and they have to do it at that price on the day you enter the order. But with a market in real estate that has very little immediate liquidity, there's a big problem. Then within a day or so, there was 3, and I think it's now up to 8 of these where they've stopped trading them, and they've taken sharp drops. So that suggests that one of the popular investments, real estate, around the world is more or less over. And then you've had the low-grade bonds were very, very popular until about last summer, when then you realized there were problems there. So that one topped out. And then if you take a look at the whole New York Stock Exchange Composite Index, the NYA, it set its high in May and is down. The bank stocks in the States are down. Bank stocks in Canada are down from the highs of last year. But you've had the senior indexes in the States, like the Dow or the S&P, virtually at their highs of last year. And again, there's an explanation for that, because you've got the central bankers are probably buying S&P type of stocks. They're certainly not going to go out and buy a whole lot of small things, so they just put their orders in. And it's becoming quite distorted, where you have a 2-tier system, the general broad market, which is weak from last year, and then the select stocks that are almost at their highs. So there's a disparity there that's fascinating. And then, but what's provided some happiness this year is that the commodities and junk bonds and stocks got hit so hard going into January that set up a terrific rally, as one would expect and what we were looking for. We've had all the measures on the oversold, and one of the performing class in there has been of late long-dated Treasury market in the U.S. and in Canada, government of Canada. The rally is now exceptional, and it has driven the action up to what we would call an upside exhaustion. Now, on this kind of a move, it can go a little further, and we can get some more upside exhaustion figures. But what our technical research is saying is that, hey, this is now a runaway market, and it would be very close to rolling over. So here is another big hinge in global finance. Sure, you've had the central bankers buying the bonds in Europe and in North America, But it's not just the central bankers buying. You've also had funds, that have to buy fixed income. And then you've also had the general public who prefer fixed income buying. So it still is a market, although you have a very motivated buyer in there with governments and bureaucrats, which is suspect. The markets can still break when you have enough of less motivated players in the game, and you still get the same technical measurements of extremely overbought. And our work, technical set of indicators on the bond market for decades has been reliable, and what we're doing right now is setting a top in the bond market, where what we're doing, and we haven't published it yet, is that if you look at the previous game before the new financial era started, that was commodities soaring to the moon in the late 70s to 1980, and with that, interest rates going up, and the long treasuries in the U.S. got up to 15%, and in Canada, they got up to 19%. But people were saying, well, why buy the long bond when you can get 15% on treasury bills? No risk. So that was, of course, just when the change came in. But you had excessive speculation driving commodities up and yields up, which, of course, lends itself to our technical analysis. So what we're getting now are a set of signals that are opposite to interest rates when the long treasury was at 15% in 1981. I mean, this is remarkably exciting stuff. The symmetry or the asymmetry is fascinating. So it's not going to have a happy ending. This degree of speculation never ever has a happy ending. It may go for some weeks yet, but it is building its own reversal. It'll be interesting to see when it comes in.
We'll have more with Bob Hoye right after the break.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're chatting with Bob Hoye. Bob, getting back to bonds in Europe and Japan now, negative bonds. In Japan, 20-year bonds are now negative. In Germany, first time ever, the bank bond for 10 years is in negative territory. Who is putting their money into something that is guaranteed to lose you money?
Well, the bulk of it, I guess, would be financial institutions, and you have to park money somewhere. And so there's so much pressure to get positioned that the market's right down to negative on nominal interest rates. Like, by nominal, I mean the interest rate you get when you invest in something like right now. But then there's another way of calculating interest rates, and that's to take the rate of interest and compare it to the rate of CPI inflation. And that one's interesting in financial manias because you can get down to minus on real. And that occurred as the market in big bubble was blowing out in 2007, and collapsing in 2008 in the U.S., and we always stay in the senior currency for data. So it got down to, I think, minus 1.5%. And then in the 08-09 disaster, that real rate went up to 6%. So it had, let's say, 7 percentage point increase, which was very distressful. But then if you take the history of real long interest rates in the senior currency back to 1700s, following each of these great financial bubbles and their consequent collapses, real interest rates, in some cases, they declined with the boom. Sometimes they got to minus, sometimes they didn't get to minus, they got to zero or slightly plus. But that didn't matter. What matters is after the boom is over, when everybody's then getting out of credit, is that the increase in real long interest rates in the senior currency and senior economy is typically 12 percentage points. So if you look back in 2008, 2009, where the increase was about 7%, and they then called that the worst calamity since the 1930s. And the reason why it wasn't as bad as the 1930s is because on that one, real interest rates increased by 12 percentage points. That was only, say, half of it. And this is what I think is ahead of us, because this credit market is really, really bizarre, pushed to the limit, and Mother Nature at some time comes in and corrects the excesses. And when you can measure the action with reliable technical tools, and you can say, hey, this is now setting up to be opposite to the huge action in 1980-81 when the speculation was on rising rates, and now the speculation is on falling rates. And it is going to be fascinating to see it turn. And when it does start to turn, and this is where one can get into the history of central banking, because the Federal Reserve was started in 1914, and the observation was is that when you had a setback in the credit markets, it was followed by a recession. So the theory was simple and attractive. By a judicious injection of Fed credit, a setback would be prevented, therefore you wouldn't have recessions. Well, since 1914, there's been 19 recessions and some very severe financial collapses. So the theory's not working. And so we'll see here. I think when this one eventually reverses and a severe contraction comes in, I think a large part of the public will take a look at all the money that the central bankers have taken, the taxpayers on the line, and they're going to take a look at that and say, look, you wasted a whole lot of taxpayers' money, and your theory didn't work. Now, that's going to be a very exciting time.
Yes, well, as you say, exciting for a lot of people, a huge headache.
Yeah.
Bob, thank you so much for chatting with us.
Good to be with you, and let's look forward to talking next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Our YouTube channel is Talk Digital Network. You can find us on Twitter at TalkDigitalNet. Questions for Bob can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.